Hi everyone, Ted from LTM Elite Consulting. I came across this article today, the 4-year end tax tips to get on track for 2024. And I just wanted to share with you guys. It's very informative and hopefully it can be helpful to you. It says here, the end of the year is a great time to start thinking about your taxes for the upcoming year. And right now we just started, today's October 1st, so we have literally 90 days, and it's a great idea to kind of like have everything lined up before the year starts. It says here are the 4 tax saving tips you can do now to help you get on track for 2024. Max out your IRAs. So a lot of people, it says right here, IRAs are a great way to save for retirement and reduce your taxes. For 2023, the maximum contribution for both traditional and Roth is $6,500, is $1,000 more if you are above age of 50 or older. Investing in a traditional IRA and contributing the maximum can help you reduce your taxable income, which can lower your tax bill. So if you are into a 12% or 22% bracket, maybe it might be a good idea to contribute some extra into the traditional IRA. But if you are not making as much due to whatever circumstances, then maybe traditional IRA might not apply to you. And it says here, and while you are contributing to a Roth IRA, now the difference, aren't tax deductible, you can save money on taxes later because Roth IRA always allow you to make tax-free withdrawals as long as you are age 59 and a half or older and you are owned the account for at least 5 years. So I had done videos in the past when it comes to the Roth IRA. I really enjoy the Roth IRA for me and my family. What I'm currently doing with the Roth IRA is I am treating it as an emergency account. So instead of having 3 to 6 months sitting around in a checking account, I am putting it in the Roth IRA and I have it invested in CDs. And the CDs currently are giving us somewhere around 5.25%. And you can, have a 3-month CD, you can have a 6-month CD. So just in case some type of an emergency arises, you cannot touch the gains. However, whatever money you put it into the Roth, you don't have to wait until you're 59 and a half. Again, this is a technique that doesn't apply for everyone. So please check with your financial advisor on that. The next step, it says here, offset gains by harvesting your losses. Here's another great opportunity. As the year gets closer to end, we have right now 90 days. If you see some type of opportunities out there, especially if you have it in the brokerage accounts, you can use those losses. And it says right here up to $3,000. So I'm just going to read this portion, right? If you have investment losses in 2023, you can use them to offset your investments gains and up to $3,000 on ordinary income. This strategy is called tax loss harvesting and is one more way to help you reduce your taxable income. In short, you can sell investments at a loss to offset your gains in another investments. So, for example, if I'm purchasing the S&P 500 and inside the S&P 500, the holdings for that, let's say I have it with Vanguard, I have a 10% loss. So if I have $10,000, the 10% will be $1,000. So I can take the $1,000 loss, and it says here you can purchase something to offset the gains. So for me is, again, what I'm currently doing is I'll take that and I'll buy something very close to. So if I'm holding Vanguard, what I'm going to do is I'm going to go purchase maybe something with Schwab or a Fidelity. You cannot get an identical because then it's a wash sale rule, which it gets a little bit more complicated. Or if you wanted to wait 30 days and you can buy after the 30th day, you can buy the same exact holding. Now you created that loss. And for people, it's only $3,000 per year. But if you have, let's say, a lot of money invested and you can take the losses and then buy something else, you can continue to use the $3,000 for other years to come. Again, check with your tax accounting, your CPA. This is just what I'm personally doing as well. If you buy the same investments or any investment the IRS considers substantially identical within 30 days before or after you're sold at a loss, the loss will be dissolved. If you need guidance on whether an investment will be considered substantially identical, consult a tax advisor. Great. So that's what they're talking about. The third one is learn the implications of changing your filing status. Your tax filing status can have a significant impact on your tax liability. If you're considering making a change to your filing status, be sure to understand the possible tax implications. For example, if you are married and filing jointly, you'll have a higher standard deduction and a lower tax bracket than if you are filing separately. However, if you have high income, you may be able to save money on your taxable by filing separately. Considering your options now can make for a smoother tax season in 2024. So that's something that we, with our clients, we look into their past taxes as well as their current, how much withholdings has been so far year to date. And then we make up the setup if it's needed for the 2024. This is information that is very important because you can save in the long run, and instead of paying extra towards the tax implications, you can use that towards your saving in the investment accounts, in the IRAs, traditional, or even in the brokerage account. Seek tax efficient investments. Step 4. When you choose tax efficient investments, you can help reduce your tax bill for 2024 and beyond. Here are some examples. Tax deferred accounts such as traditional IRA, 401k, allows you to defer your investments gains until you start withdrawing your money. Tax exempt investments such as municipal bonds are exempt from federal income tax. Tax advantage investments such as 529 plan and health saving account, HSA, offer tax benefits that can reduce your tax liability. So this is a lot of information. So what I can speak regarding to what I currently did as I was working before for the corporate America, using the 401, we had a 401 as well as a 457. I was using the tax due to the tax bracket that I was, making the money, me and my spouse. I decided to reduce my tax implications. So what I did is I was increasing my contribution into the 457 plan, and I encourage a lot of people to look into those options, as well as we were putting as much as we were able to into the HSA account. That way, we were lowering our tax bracket. And those are tools that in the long run, it adds up, especially having your money being invested in the market for the long run. And here the disclosure at the end. I just wanted to have you guys read this. This was from Vanguard website. All the information here, if you guys wanted to take your time and read this on your own, is in the last page if you want to pause it and read it. This is the disclaimer from Vanguard. I wish you guys the best. This is a perfect time to consider looking for ways to start 2024 fresh. You guys have a good time. Nice talking to you. Till next time.